It's a watershed moment for the world's largest economy. And the world too. The Fed has pivoted, cutting rates for the first time in more than 4 years. It's turned a corner in its fight against inflation, but real risks remain in the US labour market. So is this the start of a gradual return to normal, economically speaking? Will Fed Chair Jerome Powell succeed in achieving a rare soft landing? Or are we on the cusp of a painful crunch? No one knows, not even the Fed. That's why on this momentous week for the global economy, we thought we'd stick to what we do know. The impact of this change on borrowers and savers, in the US and overseas. It's what we do here on Reuters Econ World. Every week we pick a phrase or buzzword and go deep on the economic principles and ideas driving the biggest news around the world. So this week, rate cuts. I'm your host, Carmel Crimmins in Dublin. So for the week that's in it, I'm joined by two of the stars of our Fed reporting team. Saphir, who's dialing in from the Reuters office in San Francisco, and Howard Schneider, who joins us from the porch of his home in Tacoma Park. Howard, welcome.
Thanks for having us.
Hey, Carmel.
If I could start with you, how momentous is this?
I mean, this is a big deal. We haven't seen a rate cut since before the pandemic. And it's not just the actual cut itself, it's what it marks. It marks the end of an era when the Fed's only focus really was fighting inflation. And now we're going to see a lot more emphasis on making sure that the economy does well and the labor market doesn't crack.
And Howard, this is coming a lot later than we expected. I think you and I had a conversation back in December 2023 about getting ready for rate cuts.
Well, it was kind of teed up for March initially. And then the inflation data in January and February, really through the first quarter, just didn't behave. And they were faced with sort of making a judgment. Is this a temporary kind of seasonal problem? Is it going to prove to be noise in the data? Or have we underestimated here what it's going to take to squeeze price pressures out of this economy? So they waited, and they waited a good 3 months until June to make sure that they were really getting the signal back, which was the signal of disinflation. And then they had to become a little more confident in that. So they skipped over July, even though some people were ready to cut rates then.
Mm-hmm.
And so, here we are heading into the fall, September, with the first rate cut in the books. And it was all a matter of just being sure they weren't going to allow inflation back out of the bag, which is the thing that Jay Powell has said from the get-go he was not going to do. He felt that was the mistake prior Feds had made in the 60s and 70s. That's what encourages expectations to sort of fly off the handle. And that's harder to fix than if you keep it suppressed from the outset.
Now, can we get into the financial plumbing a little bit? Because everyone, myself included, talks all the time about the Fed's cutting rates, it's raising rates, but it's not like they sidle up to banks and go, you need to charge this amount to your customers, right? What is the rate that's cut? And then how does it ripple out to the wider economy?
So the Fed targets a rate which is what banks borrow from each other overnight. Sometimes a bank will end up at the end of the day short of a little bit of cash. It needs to borrow from another bank. So the Fed essentially sets that rate. That's called the Fed funds rate. And it's a very short-term rate, obviously. It's overnight. And it's between banks, so it's very specific. But then what happens is benchmarked to that rate are all the other rates throughout the economy, the shorter-term rates that people borrow from that they see go up and down, like credit card rates or even auto loan rates can be pegged to those very short-term rate. And then it ripples out through the markets in the longer term rates that people are more familiar with, like mortgages, 10-year treasury yields are a benchmark that often used for that.
Mm-hmm.
So the Fed only really controls that very, very short-term rate, but because everyone looks to that and then bases their pricing off of that, it ripples out through the rest of the market that way.
And so when the Fed changes the federal funds rate, how quick do we see the impact?
No, it's already happened. And I think that's the thing to recall, and they talk about the transmission of monetary policy.
Yeah.
Markets don't wait for events. They base everything on expectations. And once they're pretty certain that rates are going to go down, you've already seen declines in the 30-year mortgage rate, for example. Lowest had been in a while, heading towards 6%. They were 7 and above at one point. So the adjustment's already occurring.
Okay.
It'll continue to occur. It'll possibly accelerate if they go faster over time or whatever, but it's already happening.
And then there are some very short-term loans that are based with short-term rates that are tied directly to the Fed funds rate. So now that the Fed has cut, you will see very immediately a slight drop to your credit card loan rate or your home equity loan rate or something like that. Those are actually, they move in anticipation, but they also move actually with the Fed's rate itself.
So Howard, you mentioned there the mortgage market and the fact that rates on 30-year mortgages have already reacted, like they've already come down based on expectation. But the mortgage market is kind of funny in the US. I mean, I'm coming at it from outside the US.
Mm-hmm.
Like the US, like 30-year fixed rate mortgage. Like, wow. I come from the land where we track the ECB rate. We've got, your fixed rate only lasts for maybe maximum 5 years. I feel like we're all playing Russian roulette out here with our our finances. Meanwhile, in the USA, 30-year fixed rate mortgage. I mean, you're kind of insulated from the Fed's moves, right?
Well, if you've already borrowed money, but then don't forget, there's a big market here for refinancing. And when rates are falling, people that borrowed money over the last couple of years at 6.5% or the high 6s or 7% will start shifting into cheaper mortgages. That's a way that loosening financial conditions and Fed rate cuts can actually help the economy out, because you get a percentage point off your mortgage. You've got more money in your pocket month to month, more money to spend or save or whatever. So that's a way that monetary policy transmits. I think it's weird compared to Canada and parts of Europe to do the 30-year mortgage. That's the norm here. But it's a very liquid and fluid mortgage market as well. And as rates tighten up, housing sales slow and people get stuck in their home and they stay there because they don't want to give up their cheap mortgage. That certainly was happening, and it perhaps slowed the impact of monetary policy the last couple of years. But the reverse is true as well. As these rates start to drop, people will refinance, people will start buying houses, sales will increase, and you'll see some impact on that as well.
You may see some other impacts as well. As rates fall, then the developers and the construction work, that will become a little cheaper for them to finance, and then you could potentially see a little more supply. That's also been a big reason that housing is so expensive and has been rising so much here, is because of the limited supply. So that could also help on the other end. And one thing you got to remember, the reason that the Fed is cutting rates right now is not because the economy is falling apart and the labor market is crashing.
Right.
But it's doing so to prevent that from happening.
Yeah.
And a lot of what's going to happen in the housing market and the broader economy is going to depend on whether the Fed is successful in achieving this soft landing, or whether we see a lot more deterioration in the labor market. And then that would follow through in an unfortunate way into loosening the housing market as well.
US rate cuts resonate far beyond US shores because of the role of the dollar in the global economy. In fact, traders have already added to bets for rate reductions by other central banks. One central banker under huge pressure to follow the Fed's path and cut rates is Michelle Bullock, the head of the Reserve Bank of Australia. 13 rate hikes since 2022 have imposed a heavy toll on mortgage holders there. Bullock spoke recently about the letters she receives from some of them.
Personally, I do find it difficult to read some of them, and I can't respond to every single letter I receive. Some I do try to respond to, but it's difficult, to read about it.
Wayne Cole covers the Australian economy and is based in Sydney. Wayne, why are mortgage holders in Australia so exposed to rate increases?
It's because most mortgages here are on variable rates. 80% or more mortgages are variable. And so the mortgage rate rises with the cash rate. Now, the cash rate has gone from 0.1 in the pandemic to 4.35%. So mortgage rates are now 5.5%, 6%. That's added more than $1,000 for monthly payments to every average mortgage. Now, also, the house prices here are really high. So mortgages are very large. The median house in Sydney is $1.2 million. And that's a home. That includes apartments.
So how big is the average mortgage in Australia?
So about $760,000 for an average mortgage.
Whoa.
Yes, it's very painful. And there's an added wrinkle. In Australia, the tax system really favors investment properties, buying a property to rent out. There's a huge tax benefit in doing that. So lots of people, right, own rental properties, right? Lots of people. So they tend to have 2 or more mortgages. So then it doubles up the pain.
So why isn't the RBA following other major central banks in cutting?
Inflation, unfortunately. Inflation here started to pick up slower than it did abroad. So they started raising rates later than they did abroad. And they also haven't raised them by as much because, the Fed rate's 5.25 to 5.5, 100 basis points more. So inflation here is slower in coming down. The RBA, Reserve Bank, aims for 2 to 3, 2.5, and core inflation right now is 3.9. And it doesn't look like it's going to get back in the band until next year. So the RBA has essentially said, sorry, no rate cuts this year for you.
Will the Fed's move make any difference?
It already has in some ways because it's got the markets really pressing for a cut. The market assumes that wherever the Fed goes, everybody else eventually follows. So the markets are actually betting the current implied rate is 88% probability they will cut in December, even though the RBA says it won't. So we'll have to see who wins that one.
So we know that this is good news for borrowers, for people with a home loan or a car loan, but what about the other side of the fence? What about for savers? Not so great for them, right?
Well, it depends on your, I think, frame of reference here.
Okay.
Because if you go back to 2018, 2019, 2017, 2016, there's been no return on fixed income really worth speaking of for a decade.
Mm-hmm.
And now you've got some return and people have flocked into online savings accounts, CDs that are paying 5%.
Yeah.
That's a good risk-free, that's a nice thing. And it's exceeding inflation right now, if you can still get it. I think what's interesting here is we're going into an era right now where a lot of economists and certainly people at Fed feel that going forward, we're going to be like back to the 90s, back to the 80s. You're going to have a reasonable level of inflation and a reasonable level of the policy interest rate and probably higher long-term returns on long-term securities like 10-year treasuries. So you may be getting 3.5%, 4% on a 10-year treasury bond going forward. That's different than it used to be.
Yeah.
When the 10-year was kind of heading into the 2s all the time. So yeah, bad news if you want high inflation and high returns. These things kind of go hand in hand. You can't have one without the other. If you want to have high inflation and high returns on fixed income securities, that's one way of running an economy. They want stable inflation, and the premium on that, the real return you're going to get on a 10-year treasury, U.S. treasury bond, for example, is going to be somewhat above that, right? But it's not going to be 0 anymore. It might, but it's not going to be 6 or 7 or something like that. So,
yeah, I was just going to say, if you think about the stock market, I mean, regardless of what's happening the day of the rate cut over the sort of medium term, lower borrowing costs should help corporate profits because they do a lot of borrowing to finance their businesses. So that should help push the stock market up, all things being equal. Then again, I mean, we have the problem of if the rate cuts result in a soft landing, then all is good.
Right. If
the rate cuts means that then things deteriorate further in the labor market, and then all bets are off. So lots going to depend on how the economy goes from here.
But, sentiment matters hugely. Like, how should the average US consumer feel about rate cuts?
Well, I think it's how should they feel? How will they feel? It's two different questions, right? Always puzzling through this. In a situation right now where the interest rate is way above neutral, right? The neutral's a fuzzy concept. We don't know exactly where it is.
Yeah.
But right now, the Fed is restricting economic activity to try and make sure inflation stays in check. You want them to get back to neutral. Right? You don't want them to have to cut to zero because then you're in trouble. But you don't want them to have to stay up where they are forever either, because that means there's inflationary pressure out there and you want to get back to 2%, to equilibrium. So the fact that they're cutting, the fact that they feel comfortable with this, I think is a good thing. It's a good sign that they feel that they can drift back down towards neutral, hopefully keep the labor market and growth on track around potential, around the long-term sort of stable rates for all that stuff, and get back to this kind of, thing where everything's in balance. There's no free lunch out there,
No.
Yeah.
We know that on this show. But just to explain to our listeners, the neutral rate is the rate at which the interest rate isn't, turbocharging the economy or dragging it under. It's kind of keeping it on an even keel.
That's right. They work in terms of this concept called the neutral rate. And,
Yeah, whatever that rate is, we don't know.
Whatever that rate is probably somewhere around high two-ish for the US, maybe 3. Some people have upper limits of 4 and lower limits of 1. So the fact that they feel comfortable getting on a path back towards neutral means they feel inflation's about where it's supposed to be.
And I would just say, like, from the point of view of just a regular person who's been dealing with the prices rising so quickly, every time you go to the grocery store, you notice it again. I think that the Fed finally cutting rates is a sign that things are going to get back to normal. Not that your prices at the grocery store are going to fall.
Right.
Or that the prices of everything else that you pay for, your airline ticket or whatever it is, it's not that it's going to fall, because actually you don't want it to fall, because for prices to fall, that actually means that we're in a recession, if not a depression. So you can't expect the actual prices to fall, but this is a marker that the Fed is confident that the rate of inflation is falling, and it's going to keep falling to where it just is in the background. And as your wages, for those people who have a job, wages are rising. They have been rising faster on average than inflation. So your wages are going to catch up if they haven't caught up already. You are paying a lot more for those eggs, but what's coming into your pocket for most people has also risen. So as that evens out, things are going to get back to more normal. You're not going to be thinking about prices as much. That's what this rate cut means to regular people.
God, an optimistic note on an economics podcast. I feel like I should set off a firework. Guys, thank you both so much for your time.
Thank you.
Sure thing.
A big thank you to Anne, Howard and Wayne, and everyone who covers economics at Reuters. You can check out their great coverage on Reuters.com and the Reuters app. There's also a newsletter to accompany this show. You can sign up for it on Reuters.com or the app. Sound design, music composition and engineering on this episode was by Josh Summer. Our podcast team includes Kim Vinnell, Tara Oakes, Gail Issa, Jonah Green, David Spencer, Christopher Walljasper and Sharon Reich Garson. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our weekday show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.